Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. Welcome to the latest episode of the Prime Property Finance Podcast with myself, Gareth Morgan. And this week we have David Whittaker, who is CEO and Managing Director of Keystone Property Finance, who are a specialist lender within the UK buy-to-let finance market. Originally launched Keystone in 2007 with approximately 200 million of buy-to-let mortgage lending before the credit crunch halted further expansion. And then David successfully relaunched Keystone in 2012 with funding from Aldermore Bank before later partnerships with Paratus and Keystone as an independent lender in 2018. David used to run his own mortgage brokerage, which he started back in 1990 and became one of the main UK lending specialist mortgage brokerages. He's also a founder member of the NACFB and served as president in 1994 and also in 2001. And he's been the recipient of many awards within the UK mortgage market. Mortgage Personality of the Year in 2017, Outstanding Contribution in 2018, and a Lifetime Achievement Award. And this was back in 2009. So it shows how long David's been around for. He's a great personality. He's a great character. He's a great bloke. What he doesn't know about the mortgage market isn't worth knowing. As you'll tell from the conversation, he's very well educated. He knows his stuff. He's been around the block and super excited to have this conversation with him. So let's jump into it with David Whittaker. Welcome, David. It's fantastic to have you on the show. Very excited, as I mentioned when I was asking you to come on. Every time I've seen you speak at an event, a roadshow or anything, you always entertain me with your presentations, with your wisdom. We joke about the fact that you've been in the industry almost as long as I've been alive. I didn't want to drop that in, but I thought it would be important to get us off on the right foot. So welcome.
Well, Gareth, thank you for inviting me to join you today. And I think we met this year only 3 or 4 weeks ago when there was a buy-to-let event down at Cardiff Bay. And we looked out over the water and we discussed the meaning of life and one Donald Trump in the White House. But we'll move on swiftly.
We will move on for now, but I'm sure you'll rear his orange face again very shortly. So, do you want to just, for our listeners, do you want to just give us a quick rundown of who you are, where you've been, and what you're up to at the moment?
So as Gareth has already pointed out, I am the oldest man in the mortgage industry. But prior to joining mortgages, I spent 10 years soldering. I was in the Royal Engineers and I managed to bluff my way up to the rank of major. And I thought, get out whilst you're ahead, laddie. But it was a great experience. And for those of your viewers who spent time in the armed forces, they are special memories that you can tap back into and have a quiet chuckle about. And in fact, my eldest daughter and her husband are serving in the British Army to this day. So I came out of the Army in 1987. Along the way, I'd picked up a degree in civil engineering from Sheffield University, a reassuring 2-2. Don't want to seem to be too keen on the matter. And I fell into the world of mortgage broking. And I joined a company called John Charcoal, which probably at that stage was the preeminent London mortgage brokerage. And they had some great ideas. And it was owned by 2 people called John Garfield and Colin Wishart. And they were incredible people. They built out mortgage broking as we understand it to this day. So I was very fortunate to be there for 2 or 3 years. I then joined another London firm and left all of that in 1990 to set up my own brokerage house called Mortgages for Business, rebranded last year to Mortgage Finance Brokers. And we were lucky. we got involved in buy-to-let very early on. We watched Paragon, who weren't then called Paragon, they were called Home Loans Direct, enter into the buy-to-let market in about 1992 after the first Gulf War. And we joined that residential investment property mortgages, as they were called then, before Arla brand named them buy-to-let. And you won't know this, Gareth, but in the first few years, Arla would restrict the number of lenders who could use the buy-to-let kite mark to 10, and they'd charge them £20,000 a year. And that was nearly 25 years ago. So that was a nice little earner. And so we grew our business on the back of the buy-to-let market. Names that some of your more senior investors will know: Mortgage Express, The Woolwich, Paragon. Oh gosh, CHL mortgages as they were then, they were capital home loans. Some names have grown, some have disappeared. And that is why to this day, Paragon are referred to as the big beast. If it wasn't first invented in Paragon's big office in Solihull, you couldn't do it in the market. It had to be rolled out by Paragon first. And we grew our brokerage house alongside that. And John Heron, who you will recall, Gareth, the managing director of Paragon Mortgages, one of the nicest, most charming, hardworking people in the industry. He was we always used to refer to him as the king of buy-to-let. He helped us all grow the industry, and we all did well out of it. As your clients came into the market, some of whom were just frustrated with personal pensions. They wanted control of their future and their destiny. So we grew the brokerage house off the back of that. And gosh, we had a couple of dummy runs at being a lender. We worked in partnership with Bradford and Bingley, they're no longer here, up to the credit crunch, or some people now call it the GFC, the Great Financial Crisis. And then we returned in 2011, 2012 with the founding directors of Aldermore Bank. If you remember Mark Stevens, Robert Lanke and co, we helped them put a product together. It was then white labelled. And we had a brief sojourn working with the guys at Paratus, who own Foundation Home Loans. They did the simpler clients. We did the more complicated clients. And we worked alongside them for 3 years before we went to the City of London and set Keystone up as a wholly separate legal title holding company, own resources, own processing platform, own team, and with institutional support with a securitization program. So it was kind of grow up moment. And that was 2018. And I think you've kindly worked with us virtually since we launched as a full license title holder lender.
Yeah, so, well, an incredible journey. And, congrats, because obviously there's been lots of ups and downs during that time. And I bet you've got some stories to tell. I guess the market will have changed a fair bit. I think the way the business is probably carried out has changed a fair bit. And I mean this with the greatest respect. It's not like an old boys club, like, banking and mortgages traditionally have been. The shift in the market is quite phenomenal. One moving from paper onto digital, but also the increase in women in the industry as well. And it's been quite a journey. So I think, you've been through the full circle of it, in and out of markets as well. And not everyone's seen more than one crash, I guess. So on that note, obviously you mentioned the global financial crisis. That was back 2006 to 2008, depending on when you classify it properly. But you mentioned the likes of Mortgage Express, who were a massive lender in the buy-to-let space, and we've lost a lot of lenders since. Obviously, CHL left, and obviously have recently come back now, looking to get back aggressively into the market. Where do you see that we are in? There's a really good book called Boom to Bust of the 18-year property cycle. I'm not sure if you're aware of it, but it talks about this cycle that we move generally on an 18-year period historically. We are reaching that point now. Where do you see the market at the moment in your eyes, in terms of the S&P 500 last week closed at an all-time high, with only a limited number of lenders, limited number of firms hitting their own all-time high, and those are basically all companies in the AI space. And there's a bit of a disparity between the rest of the numbers there. And I think one of the banks issued a bit of a warning that it looked a little bit like the 2000 dot-com crash. What are your thoughts on the wider market at the moment?
Well, I think you put your finger right on the button there, didn't you? It has a feel of the dot-com bubble, doesn't it? And some of those AI valuations coming out of America is what's driving the S&P to levels that are artificial. Now, the counter-argument to that is that the UK market is vastly undervalued. I maintain a small share portfolio, emphasis on the word small, Gareth. And I look for yield. Yes, I hold some shares where there isn't a yield on them because I think those organisations should bounce back. But I hold an awful lot of other shares where the yield are between 4 and 8%. And, if there is a downward valuation on stock markets more generally, if I'm still getting 8% yield on legal and general shares, I ain't looking to sell. And you just have to weather out the storm. So I have seen this morning that Savills have revised their overall property price valuations down for this year. But then on the same token, they revised them down. They could equally revise them up if there was a solution in the Gulf of Hormuz and in the Lebanon, and therefore swap rates came down somewhat. And the first time buyers felt able to rejoin the market. Gareth, you used to work in 9-month to 12-month cycles. We now work on quarter to quarter. Something comes in off the radar. You go, where did that one come from? But equally, it could be good news. We might not have Trump in the White House, but then beware of what you wish for. So I think, and of course, what always makes a news headline is bad news. It's not going to be leading on the 10 o'clock news with the BBC of an evening. If it's good news, that doesn't make a good story. And certainly not on Channel 4 at 7 o'clock in the evening. My goodness, they need to get out of their glass half empty, get into the glass half full zone. And, when we're running businesses, and all your investors are effectively running businesses, you've got to get up in the morning and say, I understand the problems, but I'm jolly well going to, can I be naughty? KBO, Churchill's words, keep buggering on, because that's what everyone who runs a business has to do. And your landlord investors, they are running a business, whether it's small, medium or large, they have to get up each morning with resolve and say, I'm going to work my way around this.
Yeah, there's a couple of things you've alluded to there. One is the running of a business, which we'll probably touch on a little bit later on. And this is the what we would class as the professionalizing of a landlord. And we speak to a lot of people who would like to enter the market, so the newbies, for want of a better word. Obviously, we work with existing landlords, but the newer people coming into the market, we speak a lot about, this isn't a decision you need to take lightly. This is you are starting a business, and this is something that's going to be with you potentially for life. So this is a lifestyle choice you now need to make, because I joke that I was away last week and there was an issue at one of my properties, and the issues either come on the weekend or they come when I'm on holidays. It very rarely happen during the week. And so, unfortunately, that is part and parcel of being a landlord and a property investor. These things happen, and whether you've got processes in place and management in place, things ultimately land on you as the owner, and therefore you have to deal with them. And whether you are on holiday or not, much to my wife's dismay. But that's a separate subject. But the professionalizing of the landlord is super key. And like you said, we've just got to carry on, haven't you? The other thing you mentioned in there was around swap rates. I think that's quite an important piece around how the market develops. And one of the things and we were talking about news, that was it. So one of the things we have internally is a bi-weekly team meeting. And in that, one of the agenda points on there is what's happening in the market news. And for us, we keep joking that no news is good news. And we've probably had 1 or 2 meetings in the last 6 months where we've had no news is good news. There's these constant pieces in the press, in the wider economy, international geopolitics that impact us on a granular level, which impacts the conversations that we have with clients. And ultimately, I think you alluded to that from your perspective around how you release mortgage deals and mortgage rates. do you want to just elaborate on that a little bit and your thought process in terms of as a lender, how you take that news and how you deliver that into products that we would see on the market?
So I think we can both agree, Gareth, most of the lending we all do is on 5-year fixed rates. There'll be about 15%, perhaps as much as 20% of our book, they'll be on 2-year money because it makes good sense to the landlord. They might want to spin a property. So you wouldn't really expect a 5-year fixed rate to oscillate terribly much. And time was when you would probably only tinker with your product set every 4 or 6 weeks. And even then you'd think that was being a bit attentive to detail. And you do it for competitive reasons. So I want to get ahead of this lender, or I think it's about time we did that. And I saw a report the week before last where they were celebrating that the average life of a mortgage product over the first 3 months of this year was 8 calendar days, not even 8 working days. So, as much as it's been chaotic for us trying to hold on to swap rates that vanish in a puff of smoke, we had a rate cut planned for Monday morning, and I looked at the opening price of the market. We went, we'll put that back on the shelf for a few days. It's really difficult for you guys talking with your clients, and you've been talking about a deal, and suddenly you go, oh my God, that rate's going to go this afternoon. Is my client around? Is he on holiday like you were? I need them to commit to at least reserve it with the lender, and we can then decide whether we go ahead with it later. So it's been another extraordinary start to yet another extraordinary year. And it wasn't what we thought was going to happen this year. We were expecting base rate to come down this year. I never subscribed to the view of 3.25%. I think you've probably heard me rant on the subject that I thought we'd be lucky to get down into the mid threes. And here we are at 3.75%. And the next MPC announcement is on June the 18th, which is the same day as the by-election in Makerfield, where there's now a sporting 50-50 balance on whether rates will go up by a quarter point and whether Andy Burnham will become the MP for Makerfield. I mean, you just couldn't make it up, could you? It's a psychodrama all round. And yet you're sitting with all your pool of clients there and you're trying to guide them and you're thinking, well, hold on, I'll just quickly log in. Has something changed? And it's the only constant at the moment. We celebrated keeping a product out there for 15 days. Celebrating that. I mean, that is sadness on a stick, isn't it?
It is indeed. Yeah, look, and I think that just typifies where we're at the moment, isn't it? We're constantly having those conversations with clients. What do you expect the market to do? Where do you expect interest rates to do? And we try and take, as you say, a longer term view. Let's see, what are your goals? What are your ambitions? What are your plans individually? Because they change, as you say, from investor to investor, but also from deal to deal, because they might say, well, actually, I've kept everything, but this deal, I don't particularly want to keep it, but it's a good deal. I might flip it in a year or so. We need to look at those plans, and everything that we talk about is, what are your goals? What are your strategy? If you aren't really clear on those, then you need to go away and work on those and then come back to us. Because for us to advise you properly, we need to understand that so that we can work with you and give you the right solution so that we're not getting affected by the noise that's happening from day to day. And it's much easier when you've got a clear objective on where you're heading with your business.
And let's park regulation for the moment, because that will make many of your investor clients have a heart attack. But you've mentioned the professionalization of landlords. 10 years ago, my lending director would pray and wish for a tax return from a landlord and then dread what he would get in. Now we see accounts coming in from landlords and spreadsheets and lists of their properties and their portfolios that make my lending director purr with satisfaction. And we look at them and go, I'd back him as a business. All right, we're lending to them, and we lend to some of them many millions of pounds across their various companies and things. And, the sheer manner and speed with which landlords have upped their game over the last 10 years is always brushed to one side with the next regulatory bit coming down the track. But you Gareth, you think back 10 years ago and you say to your client, and you've had these properties for 5 years, and where's your last tax return? They'd go, Oh, I ain't done one of those, mate. You think, oh my lord.
What's a tax return?
Yeah, but
Yeah.
but that's not a conversation that happens these days. And much tribute to those landlords, whether they're doing it part time or full time. We see documentation coming in these days that I wouldn't say it's a straight pass through, but we're not looking for a fight. We're going, yeah, that's broadly right. Yeah, his portfolio says he's got 120,000 a year of rent, but the tax return is showing 85 to 90. Voids, upgrades, rental increases. We don't look to microanalyze that because they're running a business. You're running a business, I'm running a business. Not everything goes according to plan. So, I much respect for what landlords have achieved over the last 10 years.
And obviously, it's quite easy. There's no point dwelling too much about what's changed from the buy-to-let market, and professional landlords have had to become more professional, because the key part of that is around the regulation, isn't it? One, the increase in HMRC becoming, more prudent. Is that the right word?
I think you're being diplomatic using that adjective. I think your investor class will have another word for it.
Yeah.
Invasive, I think,
invasive
would be a word I'd recognise.
Well, they were very clear, haven't they, that they have implemented new AI technology, and last year I think they raised an additional 300 million in revenue. And don't quote me on that figure, but it was a significant figure, and that's only going to get bigger as they keep working that technology. So I think there's definitely a need, and people now are very, very aware of it. Obviously, in Wales, we've had Red Smart Wales now 6-7 years in the making, and I'm sure those systems with HMRC probably collaborate and talk to each other where they probably haven't in the past. As that comes into England now with the Renting Homes Act, then obviously that will start to generate even further. And as you say, lenders want to see, because they don't want to get caught out. If you aren't submitting a tax return and you've got 10 properties and you've got a portfolio with some equity in it, the first thing and you're lending against that, if HMRC catch up with somebody and they haven't been declaring their income, they're going to have a decent tax bill, and they're going to come. There's going to be a problem for those properties, isn't there? And then you're going to having to repossess, or whether it's going to be, there's going to be issues in there, isn't there?
It gets very messy, and for the odd landlord who might be worried about their tax return, they can go to HMRC. I think it's called Spotlight 360 at hmrc.gov.uk, and you can say, I think I need to bring my tax affairs up to date. And whilst they will ask you to pay any tax that is due, if you volunteer yourself to them, they won't come after you with a double-loaded shotgun and charge penalties. So it's a very rare conversation these days. But you and I would have had those conversations a few years back, won't we, Gareth? It's the revenue, they run this triangulation exercise, don't they? So it's land registry. Who's the name at Land Registry on number 4 Acacia Avenue? It's then HMRC. Do we have a tax return from the owner of 4 Acacia Avenue? And thirdly, the way that they catch people is they then look to see whose name is on the council tax bill. And if that is then the tenant, that then sets a hair running. So just as an FYI for anyone who's watching, that is how they might catch someone out.
Yeah, and that's it, isn't it? It's so that's the purpose of this podcast, as I mentioned, is trying to educate people and say, look, if you are in that space and you're listening to this and you've got 4 buy-to-lets and you've had them for a while and you've never done a tax return, best piece of advice would probably be, you know what, bite the bullet, get your affairs in order, pick up the phone to HMRC and just own up now. And you'll be able to manage that a lot better. There'll be no fines. There'll unlikely to be interest charged. They'll appreciate it. You'll be better off, because if it's not now and it's in a number of years' time, they will catch up with you. And so you're best off being on the front foot and being upfront and honest with them.
There is that apocryphal story, isn't there, that the London Borough of Newham had a whole team that were going around checking, and they were doing initial selective licensing, and they thought they were going to come up with about 3,800 names. They came up with 10,900 names. And this is before GDPR came in. They then shared it with HMRC and said, We don't know most of these people. And there was some rather heavy boots kicking around landlords in the London Borough of Newham. And that whole team of civil servants was a bit like a football team transfer. They then went to the London Borough of Croydon a few years later.
Right.
So, to your own example, this is something that needs to be addressed. But I think it's down to very few people now. But gone are the days where people could fly under the radar on this. And as lenders, we actually have an obligation to talk to the broker and say, look, your client isn't doing this. You need to speak to your compliance team, and you have to report, and we have to report if it is manifestly clear that an individual or owners of properties are not fulfilling their statutory obligation. I'm not going to opine what is on the tax return, but if they're not doing it, as you say, they've had it for a few years, it lands in our world. There are tricky conversations all round.
Yeah, absolutely. Absolutely. So just in terms of your side of things as a lender, have you seen any wholesale changes in the last couple of years, the way things have gone in the market from a lending perspective? What have you noticed the change in investor sentiment and structure, or the way investors or applicants then for you are applying for lending? Have you noticed a shift in strategy? Have you noticed, what are those shifts that you've seen over the last couple of years, and what do you foresee being the changes within the next couple of years?
So when we opened properly as a lender in September 2018, we estimated to the institutions 55% of our borrowers will be borrowing in limited company structures. They went, the industry average is only 20%. Well, we said, we're a specialist lender, so you'd expect us to see more of the professional landlords coming through the professional brokers such as yourselves. It now runs at 83%. Now, people have legacy properties that it doesn't make sense to incorporate, and they hold on to them perhaps even for emotional reasons. And do you know what? You can still exit those at 24% tax as a high rate taxpayer, and there is no such good tax break in town that is as good as that. So there's good reasons why there's still some kicking around as that. Of course, what we've then seen alongside those limited companies, they tend to develop legs and get parent companies and associated companies and some subsidiary companies. And that's where, whilst we all use AI, actually AI falls to one side. That's where a conversation happens between a landlord and his or her broker and then the lenders. And we maintain a technical team and say, okay, that's getting a little bit three-dimensional, but we're still with you. Keep talking. And it's pretty rare that specialists like ourselves can't get to a structure that works. But when you look at some of my monoline friends who are now doing limited companies, if it's anything more than Jack and Jill owning 100 shares 50-50, or they've got the children in on what I call alphabet shares, they fall over. But this is food and drink for you and I these days. So the structures reflect the future or ownership of businesses, and rightly so. And of course, HMOs, which were a small part of everyone's book, is about a third of our book now. Not necessarily because your landlord clients made a conscious decision to have an HMO. It's because the council have zoned that student house they own now as an Article 4 direction area. And it goes up in value because no one else will get it, an HMO in that street, without a planning permission, which they probably won't get. So it goes up in value. But all of a sudden they discover, I need a license. And there again, it's probably on with a lender on an ordinary rate, and everyone says, well, it needs to be an HMO rate. So this is where the skill of the broker comes in. Where do I move it to? And we have a bit of smart technology that most of the values use called CAMA. And we know, Gareth, your people phone up occasionally. Can you put in 4 Acacia Avenue, Swansea, whatever CF postcode it is, and we'll tell you what it's got, what it needs to have, and what it won't get, and is it going to qualify as an HMO? And that saves a lot of pain up front, because someone may have got themselves an HMO, but unless it's in an area that is controlled or constrained by planning, there's no increased value to it, because you or I could buy the house next door. And sometimes that can be a difficult conversation with a keen investor who's splashed out all this money and say, well, it's worth all this much more money. We go, not so much, I could buy the house next door. But we love those sorts of conversations to help shape a deal so that before someone gets involved in valuation costs and legal costs, and it's all back-ended, and someone says this doesn't work, we'd far rather engage with you and have a really lively conversation about the art of the possible.
Yeah, one of the you mentioned there around, the valuations and the strength of those investments. One of the things we get asked a lot is around commercial valuations or investment valuations based on usually HMOs on how they are valued. What's your stance on investment or commercial valuations?
If we're told it's an HMO and it fits on the CAMA map as being in a restrained area, there's an Article 4 direction on it, it always goes to investment valuation. So you will get, if you really break the valuation down, there'll be the value of the house as an house. There'll be the value of the planning that therefore makes it an HMO. And then the third increment is some function of the gross rent being achieved. If the house would have achieved, let's say, 18,000 a year as an ordinary family dwelling, but it's going to get 32,000 a year as an HMO. Some of that extra 14,000 a year of rent is capitalized and dumped on top. And that's how you build up your investment valuation. And I go back, I mentioned, I think the big beast being Paragon earlier on. Paragon have a three-dimensional database on HMOs that is the envy of their market. Well, I know it's the envy of their market because they keep it locked up and they won't share it with any of us. Yeah. But we use specialist valuers, which is why, sadly, with Gareth, for your investor clients, it's not going to be a quick 550 quid job and have Connell's, Gateway, all these other excellent firms go in. You want a commercial valuation. It's not going to be 550, it's going to be 850 quid. But for the which, that ordinary house that was standing there at 200,000, but now benefiting from Article 4 and a license and a likely rent, is now worth 280,000 and will lend against the 280, as you indeed will say, well, I've got 6, 7, 8 other lenders that will take that view as well. But we love those conversations of building up the story to get to the right answer.
And that's it. It's just one of the jobs that we spend a lot of time doing, as I mentioned, the purpose of the podcast is trying to educate investors on, they come and say, oh, well, it's 32,000, it's 10 times the gross rent, and it's 320,000, whereas it's a house is 200,000. Lenders are not going to buy into that. And whilst we can see how you've come up with that figure, the reality is, even if it was probably true, lenders are not going to lend on such a wide gap between the actual bricks and mortar value and the investment value. And it's managing people's expectations on, and the problem is what you'll see is somebody somewhere has managed to get a valuation like that. And then they'll go, well, so-and-so's had that done. Yes, I'm not saying it's not achievable, but the reality is that's probably at the top end. You've probably had others that have come down to the bottom end, and most things will find themselves out in the middle. And it's just trying to help people understand that. And the one of the issues that we have is that people are looking to do deals on the basis that the top end GDV is achievable, and that's where then it starts to get a little bit messy, and we can sometimes come across as a little bit negative in the eyes of a client when we're saying, well, yeah, that is achievable, but let's work on what happens if it doesn't reach that. What happens, let's work it out on the worst case scenario, and let's maybe assess that you will get that as a bonus. And that's some of the difficulty that we have in terms of applications of valuations.
I like your choice of the word bonus. That's the thing. If you get lucky on the day and it is an Article 4 direction area and the valuer likes your finish, because at the end of the day, valuers are human, they might give you a little bit of a following wind. And we're not there to challenge that. Otherwise, you'd have me visiting the properties. And trust me, you wouldn't want that. So you have to go with your valuers, but we use a broad panel for the specialist valuations. If you and I were having this conversation 12 years ago, it would have been allied surveyors all day long. And we still use them as a very large one because they are a very strong network. But there literally wouldn't be enough minutes or hours in the day if there was only allied surveyors there. So you've got lots of other really good firms in the background now, and you get to know them. And funny enough, we had a valuation on an HMO just outside what I call the ring that is Birmingham, because the whole of the city of Birmingham is now Article 4 direction. And it was literally 300 metres outside the ring. And I said, we got this HMO valuation as an investment. I said, but it's not an Article 4 direction area. And he said, yeah, but it will be soon. And it's the halo effect, because nothing can be done inside the city centre now. Therefore, I'm going to give you a semi-investment valuation. And do you know what? We sat down and we talked about it for 10 minutes and said, well, if we're going to have a valuer, and that's his view, we got to back him on it. So it wasn't valued as the ordinary house. We got not a full investment valuation, but we got something there in between. And the customer was very delighted with that as a consequence. We were happy that that was the right outcome.
Right outcome, absolutely. And this is, this is what we wanted. We want to work with lenders who take the view on things that should be done in the correct manner based on, as you say, where the market is going. So yeah, hearing things like that is reassuring, because what most people hear about valuers and things is mainly negative, isn't it? Because when things go well, nobody really says much.
just like the news headlines, isn't it?
Yeah, exactly.
Good news doesn't make news. So, we value our values. We have to trust them. Occasionally, we will have a set of numbers we really feel terribly uncomfortable with, and we did last year it was a bit of a hybrid property. It was up in Ipswich, and it was a house on the corner of a street and the house next door, all on a single title. And the house next door was in 2 flats. And we got a number from the valuer that was just horrid. And I said, no, I don't stand for that. And it wasn't for your firm, it was another brokerage firm. And at our own expense, we put another valuer in there, because that was reputation for us. And we got a figure that the customer, slightly below their estimate, but was happy with at the end of the day. And occasionally you just have to back yourself and say, no, we'll have a second stab at this.
Yeah, fair enough. And in regards, I don't know what your numbers, and I don't know if you know this, but I'm trying to choose my words carefully, but we would class it, our clients would class things as a down valuation. Surveyor I spoke to the other day would class it as an overestimation on the client's behalf, which I found quite amusing. So what do you see? Do you see people kind of, and I guess it's a lot more difficult on purchases, because generally purchases are what they are, from a purchase price perspective. But on refinances, do you see people trying it on, or do you think people are just over ambitious? How often are people, what are you seeing generally as a trend that they're coming in at what they're applied for at?
If I owned any buy-to-lets, which I don't, so I'm never compromised in my dealing with regulators or institutions, and I was doing a refinance, if I thought it was worth 350, but I was talking to you about a refinance, I'd say it was worth 370. Because if you don't try, you don't get. And there is no offence taken when the valuer comes back and say, well, it's not worth 370, but I'll give you 358. You're still £8,000 better off on your value than you originally thought. And there's no plaudits in heaven for undercooking your valuation. If you say it's worth 350, trust me, the valuer will value it at 350. Just occasionally they will come to us and say, do you know what, I think this is genuinely worth a bit more. But when they've got a PI policy, professional indemnity policy, they often stretch their necks too much. So I have no objection to everyone being a trier. It's just about managing the expectations when it perhaps bumps at a different number.
Yeah, absolutely. And that's generally what we see. And it's just trying to, like you said, oftentimes I'd say to clients, what do you actually need? Because needing and wanting are often 2 very different things. And if you're happy with a 350 and you don't actually need to squeeze it anymore, then just put it in at 350, because there's nothing to be gained by squeezing it anymore. But if you need to try and squeeze out the 370 in that example, then yeah, absolutely, let's go for it. One of the issues, obviously, the clients are coming to us now having had tax advice, and they're talking about layers and various things, which does obviously reduce a lot of the lending options. What's your thoughts around tax saving and complexity versus lending? And we've seen some people undo some of that advice because it's restricted them so much. What's your sort of view on that? obviously I know your view in terms of you are prepared to do a lot more than others, but just as a general rule.
So we tend to like to see the same directors in top co and in subsid co, and broadly the same sorts of shareholdings represented in what we call the A shares. So the A shares that have the voting and control rights. We have no problem with what we call alphabet shares, B, C, D, where you give them to your children and they're entitled to receive dividends to the extent the A shares are, but they don't have voting rights. So providing any of those junior folk are less than 20%, we just move them to one side and we can still see the ownership and control. At the end of the day, Gareth, when something goes wrong, I like to know who I'm phoning.
Yeah, that's fair enough.
To be fair, the one thing we all know about our landlord clients these days, if they drop a black mark on my loan book, sadly, it pops up on their credit record and creates a black mark or a potential challenge when you want to take them to Lend, Invest, Paragon, Foundation Home Loans. So the one of the things that landlords are very precious about and careful about is their credit profile. And whilst we can all ignore certain things, there are a few things we cannot ignore. Normally, large CCJs from HMRC don't look terribly elegant. They're a difficult thing to explain away. But company structures we're quite happy with. We see quite a lot where a landlord has done up a building and created 6 flats, and they want to keep the flats, and they shove the 6 flats into a subsidiary company and maximize the value by putting long leaseholds on the flats. That's the sort of thing you'll talk to them about all day long. Really comfortable with that, not problematic to us. We like to know who owns the freehold, and occasionally we will ask for a comfort charge on the freehold. There's no pound signs in it, but it just makes sure that the freeholder and the leaseholder do stand to be the same person. And I know that's a challenge for some of my peers. So I come from a family of accountants, so I will have to be slightly careful here. It's what my elder brother, who's our group CFO, refers to. He said, if it sounds like a wizard wheeze, it is a wizard wheeze, and it's probably not going to happen. And occasionally some of these schemes come across our desks and we say, what is the legitimate business interest for this to be happening? And you probably look at it and go, okay, I'll speak to a couple of lenders, but this doesn't feel like it will fly. I'm not here, and you and I are never going to step into the position of giving tax advice, but we have to have a general understanding of what we're prepared to countenance.
Yeah, absolutely. And sometimes we look at each other and we scratch our heads a little bit and think, like, as you say, does this make sense? And are we trying to be clever for the sake of being clever here rather than actually something? Yes, you might save a bit of additional tax. However, if you can't get any lending on it, then it's counterproductive, isn't it? So, but we have had people work backwards and change some of the setup on that basis because it became too complicated. So thank you for that. In regards to products, obviously the majority of the market is in the 75% range. I know Keystone have a couple of products in the 80% range. Do you see buy-to-let products going anywhere above that or becoming more competitive at the sort of 80% mark?
So there was a time when there was a few of us out there at 85%. But here's the challenge. If the prices and values are looking a bit soft, you don't want to be out at 85% with fees added on top, and certainly not on flats, because when flats go wrong, that's where you suffer the biggest impairment charge. So that's just the general comment. From a bank perspective, if you're above 75% and lending to 80%, unless you have a independent risk-based model, which is only the big banks have got, you have to hold nearly 4 to 5 times as much capital by lending to 80%. And it's not just on the increment, it's on the whole flipping loan. So that's why 80% products cost banks a lot more. Now, we're a non-bank lender and we securitize, but we have to hold them in a warehouse till we securitize. And guess what? The warehouse comes from A bank. So we get caught. We can't wriggle our way around it. And yes, there's a different risk to it, and you price it in a bit more. But it's this whole regulatory capital bit that goes back to the GFC again. You know, our banks are remarkably well capitalized, and every time a stress test is thrown at them by the Bank of England, they seemingly come out with top marks on it. And I think, although that's now, 18 years ago, the wounds are still deep inside the banks on taking too much risk on it. And, you know, I kind of think, and I'm not necessarily going to be popular for it, if you need to borrow 85% and you can't find the extra 5%, should you really be going for that expensive a property? Sounds like you're putting your risk quotient right on the edge as the borrower. You've got little room for maneuver.
Yeah, and I agree. And I think that the reason I asked the question was because we've seen in the residential space where lenders are now becoming a little bit more competitive. Some of the FCA have actually reduced some of the criteria. You know, you're seeing a few more lenders borrowing or offering 6 times income. There's some affordability steps being taken away, etc. So just some loosening from the FCA perspective, and just wondering whether that would fall into the buy-to-let space or not. Like you said, pretty much, but you could see it's a capital adequacy type scenario, which is restricting lenders from entering into those higher LTVs.
Yeah, and against that, you've also got the fact that net pricing on buy-to-let has reduced by 65 basis points over 3 years. So whilst the headline number may look a bit up because swap rates are currently high, the real, what we call the net interest margin that the lender earns across a portfolio used to be about 235 basis points from ordinary mortgages through to large HMOs and things, and it's now sub 2%. And you will know of lenders out there who are looking to grow their mortgage books, who are lending at only like 1% or 1.1% over cost of funds. So, you know, it's a very, very competitive market at the moment. And there's now at least 40 lenders doing buy-to-let, many of whom also now do it in limited companies. So there's lots of competitive pressure in there. But we have to work to a couple of rules that were put out in 2016, 1st of October 2016. They were called Policy Statement 16/28/16. And those are the rules that govern how buy-to-let is viewed differently to residential mortgages. And those rules have been in place for 10 years.
And I think so with the competitiveness in the market, it's always really difficult to competitively price, be competitive on price. And this is where lenders will start being, the one area they can affect is criteria, isn't it? And product lines, and being a bit more flexible with the types of deals that they are interested in and that they'll take a view on.
So, for example, there's probably 2 or 3 lenders now that are looking at, rather than buying the house in someone else's company, you buy the limited company. And so that's, you know, share purchase rather than asset purchase. And then what it becomes is a remortgage of the asset within the business to release the capital to help make the deal work. And that does require the potential borrower to speak meaningfully with an accountant. So you've avoided 8% stamp duty. You're either 0.5% or 1% on the shares. But you've got to watch out that there's no unwelcome tax bills left behind by the departing directors going, we've had a free pass, you've probably not had such a good one. So I know that we and a couple of others will do those now, and we've done a few. But there again, that doesn't fit within a sourcing system. This is down to the expertise of you and your team to say, okay, let's just get the figures down on a piece of A4, should never take more than a single side of A4, write down what your client is getting, watch out for what the vendor's getting. He may be leaving you his future corporation tax bill behind. That's fine, providing you've won on the stamp duty. And I love those sorts of conversations, because we have something called a deal clinic at 3 p.m. every day. It doesn't always meet every day, but it exists in my diary at 3 p.m. So an unusual deal coming out of your team is written up by our BDM that covers your office, Michelle, and it comes in. There's a senior lending colleague on, there's myself on, there's technical director on, and we say, yep, this works. You'll need points 1, 2, 3, and 4. And it comes back. It's not a mandated deal because much can change. But we say on the basis of what you told us, we can do these sorts of deals. And this is just how your clients are moving their portfolios on. They're saying, well, stamp duty on buy-to-let is penal. This is a wholly legitimate and proper way of doing it. How do people think that trading companies are sold in the market? You don't buy the building and the stock and the thing separately. You buy the shares in the business for an agreed price. This is no different in a discussion.
And we're seeing more and more of that now, as you say, because it's been a number of years since people have been buying property in limited company structures, since obviously some people were doing it before Section 24, of course, but obviously the popularity has grown, and that's, I'm not sure how long ago that was, 2016, it's almost 10 years now. So there will be people who have gone through that cycle, and we've been speaking to some people that are looking to sell a portfolio, and we've had those conversations with you guys, which was very valuable. And yeah, it's not as straightforward as it may seem, and serious investors are looking at different types of strategies to grow their portfolios, and this is one of them. So that it's very, very, as I joked about earlier, it's very uncommon that we would have a vanilla deal land on our desk. There's always something quirky. There's always something weird and wonderful sat in the background, whether that's a structure, a creative type deal, an incorporation, a portfolio purchase, a share purchase. Yeah, there's a myriad of different things, isn't there, that makes it quirky. And yeah, that for us, that forms part of the fun and the challenge in trying to get these deals across the line.
So can I just deal with the elephant in the room that makes the headlines? And I can, because I am of that generation. There are ladies and gentlemen of my age who are drawing their state pension, who've built a small portfolio of properties. It serves them really well. They probably still own them in their own name. They can exit on a maximum tax rate of 24%. Do you know what? They are allowed to damn well retire and take their profits and spend the gains from those profits. It's almost like, how dare you be selling up? Because for everyone that's selling up, there's new people coming in and talking to you, Gareth, and to your colleagues. And there's a number of our landlords now who we're not at all afraid to see that they've got portfolios not of 2 properties or 20 properties. They've got portfolios up to 200 or 300 properties across many, many limited companies. This is a strong, professional, robust industry. And do you know what? For my generation that are retiring, but sadly are still stuck with me here, they're allowed to do that, and they shouldn't be castigated for doing so. Well done, ladies and gentlemen. Go on a cruise.
Absolutely, absolutely. And you know, in every industry, there's people retiring, isn't there? And so landlords are retiring in their droves. Well, yeah, because they're the baby boomers, and they are the ones who started, as you say, in the buy-to-let market 30 years ago. And now they've come to the end of their road, and they will have experienced very little regulation, if any, very low interest rates, very little admin and tax, and you know, everything's changed, and therefore it's encouraged them to retire. There was an element of those would have retired naturally anyway, and therefore has it forced more to retire or leave the game? Potentially, maybe more the accidental landlords who haven't. Those are the ones probably being forced out, and that's fine. But the people coming in eyes wide open. They're going, right, I need to set up a company. I know I need to manage it in this way. I know I need to have this regulation and this qualification, and I need to do, manage my portfolio professionally, and so be it. And yeah, I think is a great opportunity. The buy-to-let space isn't going anywhere by any stretch of the imagination. As you say, more and more buy-to-let lenders coming into play with more competition, which can only be a good thing. So yeah, I think it's a great market. Obviously, I'm invested from a company perspective, but also I mentioned I'm an investor as well. So I am very, very heavily invested in the buy-to-let space, and I don't think that will change. I think it's just the way you manage it, the way you look after your portfolio and make it professional, then you can be around for a long time.
The private rental sector is an important component of property ownership in the United Kingdom. UK Finance, as you know, is what collates all the data from all of us lenders. The number of mortgage accounts is down 2.4% from peak numbers. That is not a mass exodus to the door. And of course, the average loan balances have gone up. So overall outstanding on lending is something like £330 billion or something. You know, this is a significant industry that it's not shuffling off into the sunset anytime soon. We have, for good historic reasons, well, not good historic reasons, but for understandable historic reasons, councils that can no longer build housing stock in the manner they used to 40 or 50 years ago. And I can't see that changing. And sadly, at the moment, we're not doing enough new build, no matter how much the current government shout about it. You know, you've got to look at the number of new starts, because that's the housing stock in 12 to 15 months' time. It's running at 25 to 30,000 a quarter. That does not multiply up to 300,000 a year. It only just scrapes over 100,000 units a year. Now, there's much that's wrong with planning, and the new homes builders, they're not going to build houses for free. You can't order Wimpy, Bovis, McLean homes, or even the Barclay homes. You can't order them to build houses not to make a profit. I suppose the answer is you can nationalise them, like railways are being nationalised this week. But, you know, come on. This is a sector that works on the law of supply and demand.
Yeah. No. And it's just the costs, you know, the costs of, we talk about this often on this podcast as well, is the costs of labour and the cost of the increasing in the minimum wage and NI, and then the cost of materials. You know, some materials have gone up 40%. You know, it's crazy. And obviously the Strait of Hormuz, you know, that's going to just exacerbate, if I can get my words out, that situation, isn't it? Because the knock-on effect, the lag effect of this, we haven't really had yet. And that's going to, so hopefully not last too soon. Hopefully there's a result there soon that they can get this knocked on, that because we're going to have an impact further down the line anyway. It's just how long that lasts for will depend on how long they can get it settled.
And it impacts confidence as well. It's until it's done, it's not done. We need to get it dealt with. As to what interest rates will do for the rest of the year, we're at 3.75%. I would be very pleased to see it unchanged at the end of the year. I think, you know, if there's a sense that something might be resolved soon, they might be able to dodge a bullet on June the 18th, and then the next meeting will be early August. That would be the crunch point if it's dragging on then. But if we could keep base rate at 3.75% and see swap rates coming back below 4%, that would be good for market confidence, not just in the buy-to-let space, because we price our products, but also first-time buyer space. You know, you need to have the newer cohort coming in. And I think the market is remarkably resilient. The one thing I know about all of your landlord clients, and I used to be a broker, is that sometimes they will see their glasses as being half empty rather than half full, but they are pretty persistent. They do continue to buy.
Resilience is the one word we tend to talk about a lot as well. So absolutely. David, I really appreciate your time. I know you're a very busy man. You've got lots of things ongoing. You'll have a deal clinic in not too long to visit as well, which I'm sure is interesting every day. Just to cap off then, we'd appreciate if you could share a few top tips for anyone you think, you know, from a finance perspective, or anyone who's either an existing investor or want to be new investor into the buy-to-let space in the UK. Some top tips based on your experience of the market?
Well, Gareth, the first one that I'd written down, but you actually have already touched on it very, very eloquently, is don't be over mesmerized by the tax. Keep it simple, stupid to start off with. Have a single spreadsheet. It is probably the presumed advice if you're going to do this over several or numerous properties, to put it into a simple limited company. But don't go chasing down a rabbit hole on some fancy tax wheeze. They rarely work out well. Except you're going to operate in a limited company environment, speak to an accountant, but, and I speak from coming from very accountants, don't run up a large bill, just get some basic advice and get it right on day one. And I'm only going to give you one other point. Speak with your broker. I will die on a hill on behalf of the broker community. My business is nothing without brokers. We don't always agree to agree. But if I took in every application for every point of the compass, I would get nowhere. We would just die under a welter of electronic applications, and we have got AI and stuff, but we answer phones and things. It's about the value add that the broker gives, whether it's homespun good advice on the valuation where they're being overly ambitious. God loves a trier, but you've got to manage that expectation. But keeping abreast of products. So when you do a product transfer, perhaps with us on a deal you kindly placed with us 5 years ago, you say, right, we'll put it in with Keystone because it costs nothing. And if the rates go down, we'll follow them down to the day of completion and we'll make Whittaker sweat. But at the same time, you'll be watching the market. And if there's another lender out there who, for their own pressing commercial need, comes out with a drop-dead, gorgeous product that you say, I don't know how they've priced it, but you know what? We'll invest £199 with them to see where it goes. No landlord can keep track of that. And the broker's role is absolutely fundamental, both upstream to us, well, it's upstream to your landlords as well, but in both directions to make the market work. And, it's not by chance that 99% of buy-to-let mortgages are done through the intermediary channel. So whether they like your hairstyle or your beard or not, Gareth, to all your landlord clients, speak with your team, and you would rather have a call with your landlord than them thinking they're ringing up with a stupid question. There is never such a thing as a stupid question. I learn something new every day, normally because I've got it wrong. But, it's a learning day, isn't it? And you would rather have that conversation.
Absolutely. Absolutely. David, thank you very much for your time. Thank you for your contribution to the market. Obviously, you've been involved, as we mentioned, for a while, but obviously not just within the market. I know you were a founder member of the NACFB, which for people within the market, will understand what that is, National Association of Commercial Finance Brokers. And you've championed the broker within the industry and are just all around generally a good egg. So thank you for being you. Thank you. And appreciate you spending your time with us to share some of your wisdom with us. Really appreciate it, and look forward to speaking to you again soon.
Here's the rest of 2026.
Thanks for listening. Hopefully you enjoyed that. As I mentioned, David is a great character. Hopefully that shows through. But very grateful for David to spend his time with us and come on the show. He's a very busy guy, as you can see, and also very knowledgeable. So hopefully you picked up a few nuggets there. The key message is if you're getting started, then keep it simple and don't overcomplicate things from a tax perspective, and speak to a broker. Brokers really understand the market and really understand the different deals available, which lenders do what, and the best deals for your circumstances, whether that be us at Prime Property Finance or another broker. We recommend there's loads of good brokers out there. Just use a broker because it will be valuable to you and grow in your portfolio. Hopefully that's helped you understand a little bit more about lending, what it looks like from a lender's perspective, and some key considerations. So hopefully you enjoyed the episode. If you did, as always, we'd really appreciate it if you could like, share and subscribe, or pass it on to someone that you think may be interested in it. Other than that, we'll see you on the next episode. Thank you. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.